Well, the Fed did what 50% of the folks thought would happen. No, not a 25 basis point cut, but a 51. And this is, of course, also the first cut since 2020. But as you can see, we are still quite high. We're still at 5%. Now, the whole, let's say, counter argument towards keeping those rates extremely high for a long period of time was because, look at this, look at the pace, at how quickly we reached 5%. Previously, yes, we were already at those levels. We were even double those levels a long, long time ago, even before I was born. But it took a while until you reached those highs. Now we did it not instantly, but extremely, extremely quickly. And okay, so far it has worked out, let's say. Let's see what happens in the next 12 months. Now, the Fed also anticipates 2 more rate cuts this year, 4 in 2025, and then another 2 in 2026. That's the current plan. Of course, as we know, we've entered 2024 with also expectations of what? 4 rate cuts, 6 rate cuts. We're only going to get, well, we got 1 right now, and then another 2, maybe. So yeah, a lot of things can change, but let's talk about what industries will benefit rate cuts, what stocks will benefit rate cuts. Let's talk about that in this video. I may try and make a couple of videos in the next couple of days about stocks that could definitely benefit from all of that. So if you're interested in that, like, subscribe to all of that, would really appreciate it. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, before we do that, here are a couple of comments that Brad Freeman on X wrote down from the press conference. Did not have the time to watch it all, so this is very, very useful. So output-wise, they see 2% GDP growth in the coming years. Continued improvements in supply chain dynamics are supporting durable economic growth. Cuts allowed supply chain bottlenecks to ease as intended. Economic growth was called solid. See stable second half growth for 2024 as roughly stable versus the first half mark 2.2%. Equipment and intangible investments picking back up from an anemic pace. As for the employment and consumer side, they say the following. Consumer spending was called resilient, still close to maximum employment. I mean, we've seen a couple of companies talk about the consumer spending being resilient. So far, I see no arguments towards the other camp saying, oh, this is not true. We'll see what happens in the next earnings report. If, of course, guidance has changed towards the holiday season, credit card companies, retail companies, etc., what they are saying, we'll see that in a couple of months. Second point here, the labor market is cooling but reasonably strong. Nominal wage growth is easing. The labor market is now a little less tight than pre-2019. The labor market is no longer a primary source of inflation. They see the unemployment rate rising from 4.2% to 4.4% by the end of the year versus just 4% as of the June meeting. Watching for signs of sharp weakening. Not seeing them today. Last one here, immigration contributing to better labor supply and upward pressure on unemployment. The quote here, the labor market is in solid condition. The intention of our policy move today is to keep it there. That's what we're doing. By the way, it also said that if they got the July jobs before the meeting, the previous meeting, they would have cut with those numbers in mind. So yeah, I guess they're a little bit behind. So what sectors, what companies could benefit from rate cuts? Well, number one is the REIT one, the Real Estate Investment Trust and Utilities. These sectors are typically interest rate sensitive because they finance their operations through debt, and lower rates mean lower borrowing costs. They're also sought for their yield, dividend yield that is, which becomes more attractive when interest rates fall. We've been talking this for a while, right? You have to look at dividend stocks where the stock has come down, but the business is still doing quite well, and so the yield is still quite high. Now, of course, the market is forward-looking, and so the market was anticipating cuts, and so some dividend stocks have already gone up, so the dividend yield has come down a little bit, but still, as the interest rates come down more and more people will be inclined to look at those 4%, 5% dividend yield stocks. We're going to talk about top 2 in this video. Category number 2 is the consumer discretionary one. With lower interest rates, consumers might be more inclined to make larger purchases such as cars. So yeah, we've talked about Tesla for quite a while, but here maybe Carvana as well, maybe even Home Depot and stuff like that. Industrial and energy, this sector could see a boost as borrowing costs decrease, potentially increasing investments in new projects or expansion, which could stimulate growth. Small cap stocks, of course, we've talked about the Russell 2000. Then you've got technology and growth stocks, especially those that are not yet profitable, could definitely benefit from lower interest rates. And number 6 here, lending and financials. Companies like Upstart, like SoFi will of course benefit from lower interest rates as well. And then the last 3 ones are one, housing and construction. Of course, lower interest rates can stimulate the housing market by making mortgages cheaper, thus benefiting home builders, construction companies, and real estate services. Retail, by the way, it's not just that. The fact is that we need to build more houses. We need to build more houses to have more and more supply. That will definitely drive the price of housing down. And there are a couple of companies, we've talked about that, the Zillows, the Redfins, the Open Door. I did a specific video about all 3 of those on the channel that will be in the top right corner. Number 8 here, retail. As consumer spending might increase due to lower borrowing costs, retail sectors could see an uptick, especially those gearing up for an increase in consumer activity. I think it's going to be slower than expected. There are some industries that will see, let's say, direct benefits from rate cuts, where you see an increase in the next coming months already, maybe already right now in the anticipation. But retail, since it is a personal thing, you have to look case by case, maybe category by category. People will still be spending a little bit less right now because inflation, well, prices of stuff is still quite high. Just because inflation has come down does not mean that the stuff did not increase already 20% in the last couple of years. No, things are still quite expensive. Now, the last one here is biotech and travel. So we've talked about some biotech companies already on this channel, Accelera, Ginkgo Bioworks, though that stock has done quite well in the last couple of days. Then for travel, Airbnb, Booking, Expedia, hotel stocks, stuff like that. Again, same thing as with retail. I think it's going to take a while until we see a big recovery, although those sectors have done quite well, right, since the reopening of the economy worldwide. So yeah, maybe we're going to see a quarter or 2 of some weakness, but over the long run, I don't see how the travel industry will not be doing better and better, especially not stocks like Expedia, Booking, and Airbnb. Now, I did talk specifically here about 2 stocks. So one, SoFi, fintech company was primarily involved in lending, student loan free financing, personal loans, and mortgages. Of course, there's also the technology side of things. We've talked about that. SoFi, yes, pre-2019 was purely looked at as a lending type of business, but they managed to flip it all around, become a much stronger company. But of course, now with interest rates coming down, the headwinds will become tailwinds. So decreased borrowing costs. This would make it cheaper for SoFi to borrow money, which it can then lend out at slightly higher rates, potentially improving its margin or allowing it to offer more competitive rates to customers. I've talked about that specific aspect already in another SoFi video. Then there's also increased loan demand. So lower rates often spur refinancing activity and increase demand for personal loans and mortgages as borrowing become cheaper for customers. I expect that to become a tailwind in the next coming quarters. Then we've got Zillow, of course, the real estate database company that also facilitates buying, selling, and renting. So they could see several impacts, positive impacts, definitely. Now, with Zillow, it's already one of those stocks that has seen positive momentum with the stock. With the business itself, there is still some ways to go, but the stock did already rebound from its lows because, again, the markets are forward-looking. So one here, housing market activity. So lower interest rates typically boost home sales by reducing mortgage rates, which could lead to more listing and transactions on Zillow's platform. Mortgage services. Zillow's mortgage business would likely see an uptick as lower rates might encourage more home buying and refinancing. And of course, increased traffic with more activity in the housing market. Zillow might experience increased web traffic, which can translate to higher advertising revenue and probably also more listings. Now, switching to the dividend stocks. I've talked about that at the start of this video, but there are two things here. One, interest rates and dividend stocks. So lower interest rates generally make dividend stocks more attractive as their yields become more competitive against fixed income investments like bonds. A decrease in interest rates can stimulate economic activity, well, that's the point, potentially increasing corporate profits and by extension dividends. Now, the dividend stock misconception is one, high yield isn't always best. It might indicate a company is not reinvesting in growth. And two, dividend stocks aren't always boring or slow growing. Many show dynamic growth in dividends. That's 100% true. Just because a company does pay a nice dividend yield does not always mean that it's a healthy company, a growing company, because it might mean that the stock is down 50% and so the dividend yield is now at 7%, 8% or so, but then a quarter or two later, dividend gets suspended or gets a huge cut. So that's definitely something you need to keep an eye on when you're looking for good dividend paying companies. You also have to look at the track record. And so I want to touch on two specific dividend paying stocks. One is a monthly paying one, which is Realty Income. We've talked about that in the past, but here's a quick refresher. So the business model is pretty simple here. So one, this is known as the monthly dividend company because, well, it pays a monthly dividend and not a quarterly one. This is a REITs or real estate investment trust that invests in freestanding single-tenant commercial properties in the United States, Puerto Rico, UK, Europe. These properties are typically leased to retail and increasingly industrial tenants under long-term net lease agreements, which means the tenant is responsible for most of the operating expenses of the property. Now, this is a dividend aristocrat, meaning it has increased their dividend annually for at least 25 consecutive years. And this is basically a major overview of Realty Income, so an enterprise value of around $73 billion, $4.9 billion in annualized base rent, 55 years of operating history. I mean, it's a huge company, seventh largest global REIT, $11 billion European portfolio, 467 assets, around 9.2 years remaining lease term, and they operate in 42 industries. They've had 29 consecutive years of rising dividends. If you look at the portfolio of clients, the top 20 clients, yes, number one, Dollar General, they're not doing that well right now. That's 3.4% of the total annualized contractual rent. They've got Walgreens, Dollar Tree, 7-Eleven, Wynn, it's the casino, FedEx, Tesco, etc., etc. So it's 79.4% retail, 14.5% industrial, 3.3% gaming, and then 2.8% others. If we look at the European portfolio, it's also, I mean, if you look at the top European clients, it's 11.5% B&Q, 11.5% Asda, Sainsbury, 10.7%, Tesco, 8.9%, Decathlon, 6.2%, then you've got 5.6% Carrefour. And so you see here grocery stores make up 45.9% of the European portfolio, home improvements 16.7%, sporting goods 8.7%, and then the others make 28.7% of the European portfolio. Overall, in the last 4 years, total revenue grew at a CAGR of 32.73%. Dividend yield has grown at a CAGR of 7% as well. Funds from operations, not adjusted, couldn't find the adjusted one, but funds from operations increased as much, or close to as much as revenues, 31.63% compound annual growth rate. Up next is probably, if I still had my dividend portfolio, this would be, I think, the number one there, and that's Vici Properties. Also a real estate investment trust, but more focused on, well, I would say Las Vegas, gaming, casino, stuff like that. I find it very interesting. Of course, it's a very lucrative piece of real estate to have in a booming area, let's say in a booming area. So yeah, Vici is definitely one on that list. Now, Vici started, of course, with a focus on gaming. It has been expanding into other experiential sectors, including non-gaming assets like golf courses, and has partnership with various entertainment and hospitality operators, aiming to diversify its tenant base. I believe also maybe a bowling venue or bowling venues, I think. And so what do they have? Well, they've got around 60,300 hotel rooms, 4.2 million square foot gaming space, 66,000 gaming units, 6.7 million square foot meeting and convention space, over 500 F&B outlets, over 50 entertainment venues and 4 golf courses, and around 500 retail outlets. And I mean, in my opinion, these aren't things that will go away anytime soon. These are places that always have foot traffic, high foot traffic, no matter what. As for Vici's dividend durability and growth, so 100% cash dividend raised every year while targeting a 75% AFFO payout ratio. The annualized Vici cash dividend per share has increased since Q3 2018 by 7% CAGR. And I mean, that's much faster and much better than the rest of their, let's say, competition. And here we can see that it is a fast growing company. Revenue-wise, total revenue since Q3 2020 up until Q2 2024 has increased by 243.5%. It's basically a compound annual growth rate of close to 39%. Funds from operation has grown by 275% or growing at a compound annual growth rate of 42.27%. Now, it says here dividend yield has only grown by 2.62%, but that's because, of course, the stock has also gone down. And so I'll just show you this right here. Annualized growth in the last 5 years was closer to 7.62%. So basically, if you bought, let's say, back here in 2018, you would have gotten 16 cents. Now you're getting 43 cents. I think that's quite good, especially for those of you that want to create a dividend paying portfolio that will just increase and pay you more and more each and every year. Right now, the dividend yield sits at 5%, and the same goes for realty income. So overall, that's about it. You've got SoFi, you've got Zillow, and then you've got realty income and Vici, 4 stocks. If you're interested in those, of course, there are plenty of other stocks, as we've seen, plenty of industries that will definitely benefit from rate cuts. But at the end of the day, I think, especially what we're going to see right now, I mean, the stock market did go up for 20 minutes or so, and then it fell back down. As you can see right here, we've got the pump and then we've got the dump. Eventually, for the long run, rate cuts, rate hikes doesn't really matter for specific businesses in the long run. The long run, healthy businesses will do well no matter what. But yes, when interest rates go down, dividend paying companies usually tend to do quite well because some folks are just moving away from those bonds that they were getting before, getting well paid, moving into dividend paying companies. So that's about it for me in this video. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.